Investing for retirement in your 50s can be tricky because most of the information that's out there is for people that are not yet in their 50s, that have longer to invest and save money. No longer does the save for decades really apply to us once we get over 50. So in this video, I'm going to talk about some things that I learned from investing and saving for retirement sort of in our 50s, but we really were sort of already retired in our 50s. So this has a little bit of a different spin on it and a little different perspective than what you're going to see besides just investing in stocks and bonds for decades. Hi, I'm Camille Gaines. Here and on my website, retirecertain.com, I write about what I've learned from investing for over 40 years and also from creating alternative income streams after we stumbled into early retirement, shortly after midlife. In this video, I'm going to share with you what we learned over the past decade and what we learned about investing in our 50s. If you like this information, make sure you subscribe to my channel and click that little bell so you're notified when I post new videos. The very first thing about investing in your 50s is that while you want to be more careful with risk, and I'll talk about that more in a second, you want to invest. And as we get older, it can feel like we shouldn't invest because, well, we're getting older, right? And if you're not retired yet, like most people in their 50s, then it can seem like you're having your money at risk. And if you keep your money in a money market, then it can feel like you're not experiencing risk. So money in a money market, though, is subject to inflation, depletion, and it's also subject to opportunity costs. So we miss the opportunities to build wealth when we have too much money in cash or a money market, or when we avoid investing. So it's important to manage your risk, but it's also important to invest your money, even in your 50s. Number two is consider investing in something besides stocks and bonds if that makes sense for you. And here's why. Stocks correct every few years with a pretty serious bear market. And while we've gotten really spoiled with the last couple of bear markets we've had in 2020, early 2020, and then also in 2018, the end of 2018, which almost didn't even count as a bear market. It was so fast, and it just hit 20%, which is the definition of a bear market. But more serious bear markets happen every few years, if not, once a decade, and they can really be detrimental to stock investments. It can take years to recover from those losses. And as we get older in our 50s, we simply don't have time to recover from that. So when stocks are overvalued, in particular, it can make sense to diversify a little bit more into assets that go up or at least stay even when stocks are declining. Now, bonds, of course, are that safe traditional investment that go up when stocks go down. Yet, bonds aren't very alluring because, well, they don't pay interest anymore. And we also know that when interest rates go up, the value of bonds go down. And while we don't know when it will happen, well, since bonds have been going up for decades now, as interest rates have been going down, at some point the cycle has just got to reverse itself. Not only that, bonds don't keep up with inflation. There's a problem with that. If you're stuck with 1%, earning 1% on bonds, and inflation is 2%, well, you actually end up kind of negative there. So for that reason, it can make sense to look outside of just stocks and bonds for your investments. The third thing about investing for retirement in your 50s is to have a plan. While it may seem like you're too old to finally be putting together a plan, it's super important. But in that plan, don't just be all about the numbers. Start out with what you really want in your life. This is a core part of my Ultimate Rise Wealth Plan. And it's about the life that you want, not just what you have to settle for. We get so sort of beaten down, I think, over the years, saving, especially if we've had a family, a home, all the things that we've needed to do and or pay for in order to survive and live the life or provide the life for our family that we want, that we can often lose track of what we want. But often in your 50s, usually in your 50s, you're now circling back to focusing on what it is that you want. And there's no reason to think that you can't have what you want as you go into retirement. Now, my whole approach, and this is, again, the Ultimate Rise Wealth Plan, is based on this. It's not based on withdrawals and settling and cutting your budget and depleting your assets after you retire. It's based on what you want in retirement when you finally have the time to live how you want. So have a plan, but make the core of that plan what it is that you really, really want in your life. Then figure out how you can make that happen, because you can make it happen. This is exactly where we were 15 years ago, and we said, how are we going to make this happen? And it is very doable, and that's what I talk about here. But anyway, I get a little excited about that. Don't settle. Don't cut your budget. Don't think you have to do without. Define what you want and then figure out how to get it. Number 4 for investing for retirement in your 50s is to continue to accumulate more wealth. Of course, continue to invest and let that money build, but also start thinking about income. Why? Because income is what pays for our lifestyle, that desired lifestyle that you're going to define from the last point that I was making. So when you start thinking about income, you can start putting things in place that would allow you to have the income after you retire to supplement Social Security or whatever else you might have. Because here's the problem. You may have seen my other video on $1 million and how much interest $1 million generates. Now, interest is one thing, return is another. I get that, we're going to get more return than interest. But the point being that $1 million is no longer the be-all, end-all for investors. $500,000, $1 million, amounts that we thought would be enough money are probably not, or may well not be enough money, I'll put it that way, to generate the income that we need to live in retirement. That's because bond yields are so low. It used to be that bonds paid, 6, 7, 8, 9, 10%, and retirees could count on that income. That's why they shifted to bonds after they retired, because they focused on income instead of accumulation, instead of increasing and building wealth. That's gone. We don't have that anymore. Interest rates are gone. So we have to figure out a different way to generate income from our money. Stock yields, the yield, not the return, not the annualized return, the yield, the dividend yield on the S&P 500, for example, is under 2%. Maybe it's around 1.6, 1.7% now. So that's not much income. And that leaves us to spending down our capital in retirement unless we can figure out a way to generate income. So investing in your 50s, start thinking about income. Look at this and look at things other than spending down your wealth by making retirement withdrawals, which are not really and truly income. They're spending your retirement savings. The 5th thing I want to mention about investing for retirement in your 50s is to manage your risk. Now, I know I said earlier to invest, and we do need to invest. And I know I talked earlier about investing in assets, some that go up when others do go down, like when stocks go down, for example. But it's also super, super important to manage our risk. And that all of that is part of managing our risk, holding those assets that go up no matter what else is happening. So risk management, though, becomes a lot more important in your 50s, and here's why. When you're 20 or 30 and you lose money on investment, you've got a really long time to make it up. Even when you're in your 40s, you've got decades, right? But when you're in your 50s, you don't have as long to make it up. Your earning years are, coming maybe to an end, although I like working, so I envision working for quite a few more years. My husband and I both like working. So, but we get to work from home. So we're sort of cheap. We're retired, but we're not, because we think this is all kind of fun. But most people have employment and they are going to stop working soon. And their earning years, unless they get some sort of side gig going or do something else, some alternative income stream, their earning years are slowing down. They're going away. So in our 50s, we just don't have decades to make it up if we lose money. Not only that, we don't have decades for our wealth to compound over time. So risk management becomes more important than ever when we're investing in our 50s and, of course, in our early 60s as well. One thing I like to say about this is is just to see exactly how much risk you have. This is one of the core elements of my Ultimate Rise Wealth Plan, because it's so important to know how much risk you have and look at each of your investments and apply that. And when you know how much risk you have, you can estimate. Of course, you don't know exactly, but you can estimate really, really well based on history of about how much risk you have. You can protect yourself from the various types of risk. I've got 14 different kinds of risk in my Rise Wealth Plan, most of which we've experienced over the years, and we can protect ourselves from that, but we can also estimate and know about how much risk we have. And when we know about how much risk we have, we're emotionally prepared for it and we're financially prepared for it. And when we have that emotional and financial preparation, well, we can be happy, we can live well, we can build wealth, we can have money to fund the way that we want to live. The sixth point I want to make about investing for retirement in your 50s is to, and I've touched on this a couple times already, and it's just to have those assets that hold their own or that go up when stocks go down. We know the bear markets are coming if we're stock market investors. Different types of investments can hold their own, and this applies to not only investments that we've bought to build wealth or increase in value while we own them, but also investments that we're in to generate income the closer we get toward retirement, because we want those income streams. So when you have diversification among the assets that you have to increase in value, as well as those that you're holding to generate that income, you're really well diversified. So that's super, super important to not just think about that in terms of stocks versus bonds, or bonds will protect me when stocks go down, but also think of it in terms of income streams. And the very last point I want to make about investing for retirement in your 50s is what I like to call know and low. Know how much you're spending on your investment fees. Know how much your investments are costing you, because if you can knock off 1% or 2%, I've done that with some of my coaching clients, then that's huge. Over 10 years, 15 years, that amount can make a huge difference in how much you accumulate. So while 1% can sound really, really small, and 1% is not outrageous, but goes into a whole other story, and watch my other video about this. What are you getting for that 1%, right? Or is it something that you can do yourself? But I digress. The 1% compounded adds up over time, and it has such an effect on the amount of money that you can accumulate. So know and low, know how much you're spending on wealth management. A lot of the people that I speak with and clients I work with are afraid to ask how much. They're uncomfortable. People are uncomfortable talking about money. It's the craziest thing I've ever heard of, because it's just another job that someone is doing for you. Exactly how much you're paying them makes sense. We wouldn't do that with any other area of our life. So know how much you're paying and see if you can lower the amount that you're spending. Negotiation can take place around this, as well as there are many, many alternatives to invest at a low cost nowadays. If you found this information helpful, come see me at retirecertain.com and watch this video next.